Good morning, everybody. This is Kirk Spano, Investing 2020s. It is June 11th, 2021, Friday. A little bit of a light crowd today, only probably 2/3 of what we normally get, but I think that has something to do with it being summertime and folks starting to take vacation. So, speaking of vacation, why don't you meet me in Las Vegas? I will be in Las Vegas from June 23rd to the 30th. And on Friday morning, right after I do the webinar, which will be 8 a.m. Vegas time, imagine getting up for that. I will be hosting breakfast for whoever happens to be in town. Love to meet you. I know that a couple of people are already coming. We can make it a dozen. That would be awesome. So let's see how many of you I can get out to Vegas. And I will contact the Golden Nugget a little bit ahead of time to know who I should meet to set that all up. I'll post where we're going to be. There's really two places inside the Golden Nugget that I'm anticipating. So it'll be one or the other. We'll have some breakfast. We'll talk investments. We'll talk life. Maybe we'll go put $100 into a slot machine and see if we can come up with a group jackpot. But anyway, please do email me if you're going to come. You know the email. It's letters@kirkspano.com. I don't put that in here just because, oh, I did put it in here. Look at that. Right there. There's the email. So go ahead and let me know that you're coming, and I can try to rustle up some tables. I'd like to try to be close to knowing what we're going to be doing that day. In any case, today we're going to talk about the markets and some of the narratives that are out there about inflation and where I think we should be rotating to with some of our money, given that valuations are sky high. And the new narrative that just started making the rounds this week is that at Jackson Hole, the Fed will start discussing how it's going to taper sometime later this year or next year. Now, I will tell you, I am not in the inflation camp. I do think it's transitory. I think it's a one-off. However, given the amount of inflationary policy that will offset the deflation a lot more now that the millennials, who are pretty well healed as a group coming out of the pandemic because their jobs were not the most affected, I think are going to give us a mini version of the baby boom that we saw in the 80s and 90s. It won't be quite that dramatic because there are offsets. But let's take a look at some of the narratives that are out there. Jesse Felder, who you can go to his website, or it's right here on Seeking Alpha, says that the markets have bought the Fed's transitory narrative hook, line, and sinker. Well, either that or the transitory narrative is correct. So all these folks that are out there, and they always talk about the collapse of the dollar and the fiat currency, everything else is horrible. The reality is that we're probably not going to see a collapse of the dollar, probably not going to see a depression, we're probably not going to see anything monumentally different in the next 10 years than the last 10 years. It's going to all be pretty similar. And then you throw in the fact that the millennials are coming into their peak earning years, and that's going to help us a little bit. So what can we surmise from the folks who are out there talking about this narrative and that narrative and, you know, inflation might blow us up? Well, there's a couple charts in here, and I have them all queued up and ready to go. And this guy talks about how the market doesn't believe in the inflation narrative. And I think that he's got some valid reasoning there. He says he doesn't believe it. He thinks that there's going to be persistent inflation. He thinks this is a big deal. Again, I don't. I think that we are just rebounding off of low comparable numbers. We're going to have a one-off year in inflation that has a step up. And then inflation will get back to your 2-ish% range. I'll show you some charts in a minute. But his point is that at 1.6% on the 10-year yield, which has now dropped to 1.46 as of today, And that implies slower growth, kind of slow growth forever. Where have you heard that before, right? Slow growth forever. I've been talking about it for almost a decade now. And he's talking about, well, at this interest rate on the 10-year treasury, we historically had much higher inflation, but we've also had something else, and he doesn't talk about it. And this guy talks about the transitory inflation with projections of 4% this year and then dropping back into the 2% for the rest of the decade. And his suggestion is that maybe the price for inflation protection should be higher. Again, a lot of these people have vested interests in what? Cryptocurrencies and gold. Jesse Felder talks about that right here. Should there be a higher premium on metals and energy? Well, I would argue maybe on metals, because we're going to use a lot of metals in transitioning to the cleaner, probably not clean, but cleaner energy climate. And to get cleaner energy, we need metals. So here, I think that we're going to see metals, including gold and silver, come up a bit more. But will they get over the mean, over the average? I don't know. I think a run at the mean, a reversion to the mean, again, that phrase exists for a reason. Talked about it before. And I think that reversion to the mean applies both to metal stocks in relation to their pricing and broader stock market. So I've shown you chart after chart after chart about valuations. And then we have to try to apply interest rates to the valuations. I mean, how much higher should valuations be in the face of low interest rates? I don't know that anybody can have a great answer for that. We just know that overvalued is overvalued, but that overvalued might not be as overvalued as it looks on the surface, giving low interest rates. But you've got a lot of people who try to justify any valuation by the low interest rates. And the answer is probably somewhere in between. We're overvalued, but based on interest rates, it's probably not the worst in history, but that doesn't make it normal. So we're overvalued, and nominally it's the worst in history, but adjusted for interest rates, it's probably third worst in history. Somebody mentions that in one of these articles. So overvalued, but not 1999 overvalued or 1929 overvalued, but probably more overvalued than any other period. So if we go away from Jesse Felder and we come over here to Forest for the Trees, which I recommend, and I'll have another link in there if you want to buy this for $200 a year. It's such a bargain. Again, I don't really agree with the angle that he takes on most of this, but the issues that he highlights are the ones to look at. So one of the things that he puts right at the top, and he's kind of scoffing at it, is that the U.S. debt crisis is coming. Don't blame entitlements. So this is Janet Yellen back in 2018. And what are some of the things that she says? Well, look what she points out. Aging of the population and the demographic problem. I've talked about that over and over and over and over again. But if you scan that little graphic, the only person that mentions it is somebody in the comment section. Jesse Felder doesn't say it at all. And I know he has, but he downplays it. And the reality is that population demographics drive everything. There is no other common denominator for everything other than the number of people and whether their collective standard of living is increasing. We'll get to that in just a second too. So the deficit, of course, reflects the gap between spending and revenue. Pretty easy, right? It is dishonest to single out entitlements for blame. Federal budget was in surplus from 1998 to 2001, back when the Democrats and Republicans cooperated just a little bit, and you had a centrist president, happened to be Democrat. But large tax cuts since George W. Bush and unfunded wars have driven most, if not all, of the increase in budget deficits. the primary reason the deficit in coming years will now be higher because of the reduction in tax revenue. And I'll show you that chart in a second. Not an increase in spending. And this is, again, she's saying this back in 2018. So pre-pandemic. So now we have the super low tax rates, at least for the richest couple of percent of people, but particularly the richest 1% from President Trump. And now we have all the stimulus to try to rebuild the economy. And as I said a few years ago, helicopter money was inevitable. I first started talking about that in 2012 on Market Watch. Gave an interview a couple of years ago on Seeking Alpha. You can find it under my profile. You can just Google helicopter money is inevitable, and you'll see the interview. You might need a premium membership to get to it. I'm not positive, but I do actually have a discount code for that now too. So if you want the premium service at Seeking Alpha, which I really do think is pretty good, they have taken my suggestions from the last couple of years. Whether I get any credit for that or not, I don't care. But I told them to copy the American Association of Individual Investors, all the tools that they had. Well, Seeking Alpha went above and beyond. So now I don't think anybody needs an AAII membership anymore. I really don't. Mine's lapsing because all the tools at AAII and then some, better charting, better everything, are now at Seeking Alpha under their premium membership. So for a couple $100 a year, you can have AAII, which is pretty good, or you can have Seeking Alpha, which is like AAII plus plus plus. So honestly, I do think that it's probably a membership worth having. I have compared it to a lot of others. I've given my suggestions to management at Seeking Alpha. They have taken me seriously, and I am much more convinced now that Seeking Alpha is on the right track than I was a year ago, because they scared me a little bit a year ago. In any case, when you take a look here, you have to put it into your head, okay, if deficits are going up because of demographics, is it really generosity and just frivolous spending? No, it's the way the population is aging. It's just the direction of things. So I think it's draconian to say, well, as people get older, we're going to cut them off or we're going to make them live less well, even though they've done basically the right things, maybe not perfect, but most people, they grind their way to retirement. And I think it's pretty horrible to say, well, those extra 2% a year in Social Security benefits, we can't afford that. Or we have to cut their Medicare, right? Or if you're Chinese and you say, well, let's create a disease that starts to kill them. Okay, I'm sorry, that's a little over the top, but I should have wrote that novel a year ago when I first talked about it. If some of you were on the calls a year ago, a little over a year ago, I said it was interesting to me that China has such a huge demographic problem, and suddenly a disease pops up that's going to kill old and sick people. Just throwing it out there. I think it'd probably make a pretty good novel. I think it'd be even better if you could write it in Chinese. The other thing to keep an eye on with this pandemic, by the way, is that it may not be over. Because what we're learning about the vaccines is that they do in fact have some minor side effects, but with the variants, and soon enough we'll have what's called the American variant, because a third of us still aren't getting the shot, and we're not really paying attention to having a mask on if we don't have shots. So there's going to be an American variant. But what happens? Vaccines aren't very good against it. In any case, the idea that entitlements are the big problem is a little bit of a misnomer. We've known about the demographic problem for a long time. This article is from 2007, but if you want, I can pull them all the way back to the 1980s. Tip O'Neill was talking about this stuff. So we just simply didn't plan for the demographic issues. Now, unfortunately, this is going to be a little bit hard to read, but one of the articles from FFTT, Forest for the Trees, is that as a percentage of the budget, they want to show us what the real net interest is at low interest rates on the debt. What phrase have I been using from Dick Cheney that I've been hinting probably is more right than we think? What Dick Cheney quote do I use from time to time? What doesn't matter? That doesn't matter. And I know that's hard for people to get their heads around, but the reality is that probably there's an element of truth to that. If you take a look at what we're paying in real interest as a percentage of GDP, is it close to zero? For the next couple of years, they're projecting it to be negative. So when you subtract the interest rate we're paying, right, from the inflation rate, what they're saying is that in the short term, we have a real payment on our debt. Our interest rate is negative. That's like saying we borrowed 100, but we only have to pay back 99.65, or in this case, 99.40, 99.20, 99.30, 99.50. That's a pretty good deal. This is why the bankers are irritated, because they don't have a spread that they can exploit. So everybody betting on the banks is counting on interest rates to go up. And I'm telling you, I don't think that's going to happen very much. I think 2 to 3% on the 10-year treasury is the best you're going to get. And that's reflected way out here, where the interest on the debt finally goes positive. It's actually taking a little bit of money out of our pocket. So if the debt really doesn't matter that much, and we're pulling forward the helicopter money that I thought was going to come later in the decade, which is what we're doing, and maybe we don't pull forward as much because of the dynamics of the Senate, but we'll pull forward a couple billion more, trillion more. Billions, trillions, zillions, they all get mixed up once in a while. If you saw a group of 10 centrist Democrats and a handful of Republicans, I think it was 5 and 5, agreed on $1 trillion infrastructure bill, I think that's going to get passed as a standalone thing. I do. Because I think the president wants to show bipartisan agreement. So I think you're going to see $1 trillion infrastructure plan for the next 5 years. So that means 22, 23, 24, 25, 26. But then I still think you're going to see reconciliation. Why is that? On one of the charts, I believe it was the hard to read chart, we can see what the receipts versus our outlays have been and what type of a deficit we're running. So in 2020, we ran about a $3 trillion, $3.1 trillion deficit. This year, we're projecting 3.6 or 3.7 trillion. The next year, almost 2 trillion, before it really comes down in 2023. But these numbers are going to go up a little bit, I believe, in this time frame. So the question becomes, how do you reduce the deficit in the face of higher spending? Well, you have to reduce the tax cuts. It's a better way of saying raise taxes. We have to reduce the tax cuts. And most of the tax cuts went to the richest 1%. We know that as a fact. It's about 85% of the tax cuts went to the richest 1%. So if you just roll those back, you actually pick up around $1 trillion a year. But wait, there's more. One of the signature things for President Biden, which I am hugely in favor of, is that capital gains over $1 million a year should just be counted as income. That means your small home flipper, your person who, makes $500,000 because they cash in a stock that they did well on. Maybe it's where they worked. They're not going to get nailed. They'll still get the low capital gains rate. If you're making over $1 million a year in capital gains, that's probably your business, probably not a one-off. That would raise another $500 to $700 billion a year. Just by saying to Warren Buffett and Elon Musk, Jeff Bezos, hey, those capital gains that you're making are basically your income. So you're going to pay taxes on them like it's your income. And in fact, if that's what gets passed in the next reconciliation bill, and I think it will, if the Democrats are smart, I'm not sure if that's a good accusation or not, they won't raise any income tax rates. They will leave every single income tax rate alone. So they can say, we did not raise income taxes. We simply got rid of a loophole. That's the smart thing for them to do. We'll see if that's how they do it. But I will tell you, that $1 million threshold that they keep talking about, where if your capital gains are over $1 million, it's going to count as income, that's going to happen. And that's specifically going to hit people who are making millions of dollars a year, just by how they're structured as corporations. Now all of a sudden, you go out to about 2023, and you've basically got almost a balanced budget. You'll run a few hundred billion of debt, few hundred billion of deficit. You can live with that, right? If you chop off the one there, which is just a $372 billion deficit, you kind of write that off as, that's the pocket change. Weird, right? When you really try to wrap your head around all these numbers, and I wish this was a little clearer for you, but again, I will link this. I'm going to write an entire article about what we're talking about today. I will link this for $200 a year. I just think this is one of the things you should be reading every weekend. And then you'll see somebody's take on it that's not quite the same as mine, and then you'll hear my take. You can figure out which one you think is more right. Then how does that affect you as an investor? Well, one thing that I talked about last week, and Forest for the Trees talks about this week, so the Fed plans to wind down the pandemic corporate credit facility. What did I talk about way back last August would happen when this occurred? That'll be the opening of zombie hunting season. So that'll be one of the other articles that we get out there, is the Fed is announcing the imminent opening of zombie hunting season. And what does that mean? It means the credit for corporations that aren't credit worthy is going to be tighter. That the S&P 500, which is full of zombies, 100 and 200, depending on how you define it, it's going to have some trouble. And a lot of those companies are going to shrink because they already have zero or negative growth. They have big debt coming due in the next 4, 5, 6, 7, 8 years, and the market will adjust for that ahead of time. They're either going to have to issue more shares while valuations are high, or more likely, they'll wait for the crisis because the management doesn't like to acknowledge things like this before they get their bonuses. Expect a lot of managements. Exxon was a great example. Expect a lot of managements to try to squeeze out as much as they can for themselves and throw shareholders under the bus, rather than having choppy share prices or slightly declining share prices into the face of fixing the companies. What kind of an example could we think about that was recent, where a company decided to cut their dividend a little bit, make a strategic transaction, and fix the company, and yet the market punished it a little bit? But it's probably a great move. AT&T, right? So AT&T spins off an asset, makes it better, focuses their business, resizes their dividend to adjust for the different cash flows, shows that the company is going to probably be a lot more healthy and a lot more competitive in its field, maybe being the best one in the world. But because you cut my dividend, you're dishonest, stock has been a little bit negative. Now, given that AT&T is down just a few percent, isn't that better than waiting 2, 3, 4, 5 years than really having the shit hit the fan, falling off a cliff like CenturyLink did? And CenturyLink's getting better now as Lumen, because they've done the things that we talked about 3 years ago. We talked about what Lumen needed to do to get better, and they've done those things. They split the company into 3 pieces, like we said. AT&T made the strategic transaction that I told you for years was going to have to come, and now it has. And they're unlocking value. There's a lot of companies in the S&P 500 that need to do what AT&T and Lumen have done, but a lot of them will resist it because the dividences. Don't cut my dividend. I don't care if you go bankrupt in 5 years. I just want my dividend now. I can't make fun of the dividences enough. if you don't have a healthy company, sure, you might get a little bit more in dividend for several years. And then you're going to wake up one morning and your share price is going to be down huge because you never really thought about the health of the company before, because you were just about your dividend. You probably won't be smart enough to sell until it's down 50, 60, 70%. At that point, probably a good buy while you're saying goodbye. So there's a lot of changes coming in the S&P 500, and a lot of the managements will not make the hard decision. Here's the chart on the S&P 500 that we've been working with for a long time. The red lines, the red channel represents, let me make that a little thicker for you. The red channel represents probably where the price range on the S&P 500 should be. This channel represents low interest rate environment. And notice how the round shiny number, 5,000, right, is just above the 1.618 level on our fib chart, which is a normal target for prices to gravitate to. So once it gets up to 1.618, I mean, why not go to 500? Let's buy 5,000 on the S&P. It's a round shiny number. People love round shiny numbers. Then I can see it chopping for years until it finally gets back into the channel where it belongs. That could be, we could bounce in and out of this channel for a while. So I do believe that there's probably a lid on the S&P 500 around 5,000 that lasts most, if not all, of the rest of this decade. What can you do if there's not much upside left in the S&P 500 as the zombies get killed? Well, what group of stocks have we talked about for years, including last year, early, that you want to be in? What size capitalization stocks do you want to be in? Mid, yeah. Mid caps, mid caps. We take a look at this going back to the bottom of the financial crisis. You'll notice that the mid cap index beats the S&P 500. We go back to the bottom of the pandemic, same thing is true. Mid caps win. There's some other charts that I'll put into an article to show that mid caps that are asset light do even better. So the mid caps in the NASDAQ, many of those companies, right, not smokestack companies, not sin companies, are doing even better. A lot of those are the ARC stocks. So what we can do is, if you remember our investment barbell, one moment, please. If you remember our investment barbell, there you go. These are your asset-light companies. This is where we need to be. There are REITs that make sense, but not many, because what do we know about REITs? They don't really outperform. They have cycles where they outperform, but just looking at a company like, say, Simon Property, that's in about the same spot as it was 17 years ago, you have to ask yourself the question, A, how good of a business model is it really, and how good is that management? Now we know that the same type of experience is coming to a lot of office buildings. Then we have some gold and crypto that might make some sense. I like the gold miners and I like Ethereum. And there's a trade in Bitcoin that I have that article 90% written, so that'll be out soon. Certain materials, and this is where I think you need to think about how do you adjust your portfolio for climate change? The biggest investment theme for the next decade or 2 or 3, it might be the rest of our lives, is climate change. The real estate development company that I'm starting with somebody, with 2 guys, is climate change. I have seen out-of-state purchases of Wisconsin properties for cash way above the asking price, 10 to 20% above the asking price, tens of thousands of dollars, from people who live in climate change affected places, in particular California. So they have the double whammy of high taxes and climate change problems. What one of our subscribers talked about, in fact, it was Scott, it was our new technical analyst, talked about how his parents sold their Florida home to somebody from India. There you go. Tax problems, climate problems. Not sure why they picked Florida. I mean, they probably like the weather. But at some point, even people in Florida, especially coastal Florida, are going to have some problems. That's why Central Florida is building up. If I were going to make a life somewhere in Florida, I'd be closer to Orlando than I would Miami. In any case, your portfolio needs to reflect a couple of things: asset light, recurring revenues, climate change, which metals will be in demand, which real estate will be in demand, which crypto will be in demand. And I think I've made a pretty strong argument that it's Ethereum. Again, not for a big bet, because you still have the governments that are going to get in here. And part of our 4-step process, right, is what is the government going to do? So in the United States, we need to continue to look at the mid and mid cap stocks. Some of those will include the SPACs, right? The ones that have deals, and now you can evaluate the deal. And then what country should we be invested in? Since we started talking about India, it's done pretty well. And this is the long-term chart. United States beat India. Let's take a look at the 1-year chart. Look at that, it flipped. So if we go back, in fact, to the bottom of the pandemic, which was the 23rd, it was 23rd, right? Hugged pretty close, but more recently, India has taken off. Now, as the dollar gets stronger, and it will, because of what I just showed you with the debt, they're going to fix the deficits a little bit, a couple years out. The dollar is near the bottom of its channel. There might be one more leg lower, and that's when all the chants about fiat currency and the dollar falling apart and collapsing is going to get the loudest, and it's going to be the hardest to resist. But what do we know about the dollar? Pretty range bound, right? Way back in here, everybody was telling me, I wrote the first articles in 2012, right about here. Everybody was telling me the dollar was going to keep going down from this area. And I said there's going to be a long-term bull market in the dollar. And that's what we got. And then I said it was going to be range bound and bounce around, and that Trump would be bad for the dollar because he said he was going to be bad for the dollar. Sometimes you just take people at face value. Dollar still rose as the economy was strong. And then as they did QE, it's been coming down. So what happens if in August they announce, here's our plan for tapering? Dollar will firm up, start to drift up. Or maybe jitterbugs around for a while like it did here. What if the dollar jitterbugs around for a long time before it finally heads upward, say in 2025, 6, 7? What if the United States is able, in an era where we're moving more towards a climate change regime on the economic side, what if the United States becomes a gigantic Switzerland? I think it's going to happen. That means the value of U.S. assets in dollars are going to go way up after the initial shock that everybody else feels from the change in the dollar value. So right now, we probably want to accumulate some foreign assets, some undeveloped U.S. land, I think on the edges of developed areas, the way that it's usually been done, right? No new wheel there. That's why I'm starting a real estate company. And we will do a funding round at some point. But you need to understand that the debt is relative around the world. The United States is probably in a better position to handle its debt than anybody else among the major economies. And when you take a look at who can survive in a world that is going more carbon neutral in the face of the worst routes in history, right, going back thousands of years, that we can figure out. You know, the U.S. Southwest is in just a horrible drought and is burning. There's a gigantic fire in Arizona right now. You know, I'll do a presentation more on climate change at some point, but it needs to underlie most of your investment thesis, along with being asset light. You don't want to invest in companies that are high debt and low growth, right? That's easy enough. But even companies that need money recycled through their system to turn out a little bit more money, those lower margin businesses, might be great to work for. But as an investment, you know, look, so I'm telling you here, the dollar's not going to collapse. The inflation narrative is bullshit from people who lean Austrian economists who never use the word demographics, even though it's the most important thing in economics. That's what demographics is. The most important thing in economics. So it's natural. It's something that can't be tinkered with. China's trying. China says, okay, now you can have 3 babies. Doesn't matter. People have the number of babies they have. The time lag is huge. It's a very smooth process. The only thing that's jagged is policy to respond to it in 1 and 2 year fits, sometimes 4-year fits, at least based on the US cycle. So here's the future of the world, summed up in a nutshell. Climate change is the most important issue, not only to our survival, but to your investments. So your portfolio should reflect that. Second, you want high margin asset light businesses. Companies that put in $1 but get out $1.85. Not companies that put in $1 and get $1.15. And in particular, not companies that have huge giant debts that they keep have to drive up. Somebody asked about, what about immigration to solve demographics issues? Well, that won't work everywhere, will it? Can't, right? People go from point A to point B. Point A is not going to be happy. But as the United States takes in more immigrants, particularly from Central America and Mexico, there's one thing you can't say about the folks that have come up from the South. You can't say they're lazy. So that will add to the productivity of the economy and grow the pie a little bit. But it's really all still just offsetting the baby boomers getting older. I mean, we'd have to let in, oh man, how many baby boomers turn 65 in a given day? Now the next important statistic is how many turn 70. A lot, over 10,000. We would have to let in 3 to 4 million people per year to offset what's happening demographically. Donald Trump just ran against that whole idea and got a lot of votes. Do you think there's a politician alive that can come on the stage and say, hey, we need to let 4 million people into the country and win an election? I mean, it's probably the right thing to say economically. How many people understand economics? 1 in 5? A lot of things in this world to operate on, right? The Pareto principle. So the United States is probably going to turn out to be, in the next decade, a gigantic Switzerland. You're going to see the dollar turn up at some point. When it gets up here, they're going to have to figure out a way of pushing it back down. And maybe that'll be the next fit of helicopter money when they bail out the retirement system. And then once the retirement system is bailed out, I'm talking Social Security, pensions, and Medicare. When they finally bail that out, that'll be your last big hit to the dollar. So looking really long term, the dollar is going to get stronger. And owning a second or third property for you is probably a great idea. I wouldn't buy in this market, not some house with curb appeal. I might go and find a hunk of acreage a couple miles out of a major city that you like, that looks nice, near a lake maybe, and rehab it. Buy the location. You can always put a structure on it or fix what's there. That's what we're doing. I'm going to put half of the money that I earn, that's what I've committed to. I'm going to put half of the money that I earn for the rest of my career, next 20 years or so, into long-term real estate for my family. And that can be developed in the case that there is massive climate change immigration, which I think is coming. I think it's coming because the CIA and the Pentagon told me it's coming and has already started to happen. That's largely what's going on in the southern border is about. Not entirely, but partially. So how do we invest through that? Mid caps, the companies that will replace the zombies in the S&P 500. Some of those will be SPACs. Some of those are just other companies. Talked about some of those lately. I think there's some international stocks that we can buy. You know, one that we just bought builds solar in India. I think there are some ETFs that we can buy that'll just make it easier for us. If you've noticed what Berkshire Hathaway just did, they invested in a private bank in Brazil. Remember, they invested in brokerages in Japan last year. So the nature of Berkshire Hathaway, so normally we talk about ETFs. Just think of Berkshire Hathaway as an ETF. Berkshire Hathaway is basically a managed ETF for as far as you're concerned, as far as I'm concerned. And it sits on a mountain of cash and operating businesses that generate a mountain of cash. They have something that every investor should want. What is that? Perpetual cash flow that can be dollar cost averaged back into the market. And rather than just buying based on the calendar, they wait for opportunities, which is the way you should do it too. I know that your 401k doesn't work that way, which is why I tell people you can just put your 401k money into one fund and then rebalance it from time to time. With Berkshire Hathaway, all the money goes into Berkshire Hathaway, and then they choose how to allocate it. If you ever just need a place to put money, Berkshire Hathaway is a pretty safe place to put it, and the nature of the management is slowly changing, becoming more opportunistic and behaving, again, more like a private equity firm. Everybody wants to think about the stocks that Berkshire Hathaway owns, but you should take a look at the private companies that they buy. They do operate as a private equity firm on top of acting like an insurance company, on top of acting like a mutual fund. And all those things work together. So if you think of Berkshire Hathaway as just an investor, how are they doing it? They generate income. Okay, that's your job. So when you go to work, you generate income. Those are the operating businesses at Berkshire Hathaway. And then you invest your money as it comes in into other assets. Now you can invest based on a calendar and just buy QQQ or something, or as you accumulate cash, you look for opportunities. And we know that the calendar gives you a lot of thimble opportunities, a little here, a little there. Then every now and then, get the elevator drop, and you put out the bucket. As I've said, I'm not so sure we get the elevator drop here. I think that we just get rotating corrections and maybe a little bit of a taper tantrum at some point. So we have to be diligent about buying as we go. If you're a retiree, you don't have income coming in, selling options is a wonderful solution for that, but also holding extra cash. As you sell stocks that become overvalued, if you don't have a good place to put the money, temporarily let it sit in cash. I know 1% isn't sexy, or 0.5%, whatever you're getting at your brokerage. I get a little over 1% at Interactive Brokers. I know that the other places are closer to 0.5%. But it's okay to hold cash even for a year or two until you find opportunities that make sense. AT&T, Viacom, both dividend stocks with upside. And we've had, 2-3 dozen recommendations in the last year. And again, I don't pound the table too often. I've been told I need to. So I have been more lately, the last several months. Sell the overvalued because we know the stock market is overvalued. This is the weekly chart again. When did I say the next correction would start? I said it a month ago. I'll say it again. Probably next Friday or the Monday after, the week after options expiration. I've been looking at option contract after option contract after option contract. There's a whole lot of reasons why this stock market drops in the next month or 2 or 3, sometime over the summer. Because the option contracts just look dumb. Right now is one of the rare times where you could sell covered calls on a lot of things. But if you do that, I think you trim the position too. Pull any position that's grown to 4, 5, 6, 7% of your portfolio all the way back to 1, 2, 3%. And then you can still write covered calls on part of that. This is obnoxious, right? You need me to make it look obnoxious? Here, I'll scale it differently. That is obnoxious. This is the definition of don't fight the Fed. And if the Fed is telling you that it's thinking about tapering and raising interest rates, well, there you go. That means that there's a correction coming. And this yellow box, I think, is probably pretty legit. I have a hard time believing it gets down here, but I think up here, pretty legit. So be careful. Don't have FOMO. It's way too late for that. In here, when we started talking about doing some more buy-in, made some sense. Up here, unless you think this is happening soon, better be careful. More mid-cap stocks, with increasing earnings and decreasing debt ratios, right? Because they have some debt when they get started sometimes. Some of the SPACs, especially as they call in their warrants and the dilution gets out of the way, you can get some bargains. And then some of the international plays. Any questions today? No, everybody just wants to go jump in the pool. All right. So I will get that crypto article out. Again, the prices that I have set for Ethereum and Bitcoin are quite a bit lower. Monday, we'll talk about stocks. All right, so stocks of the week on Monday, along with the option and the continuing building of our short in oil. All right, take care. All right, so stocks of the week on Monday, along with the option and the continuing building of our short in oil. All right, take care.